Welcome to this Killick Explains video. This week I want to take on a question that is being asked quite a lot, it's being discussed a lot, that is how to invest as the stock market hits new highs. A lot of nervousness around from some investors, confidence around from others, so what's the best approach? Now the background to this is what? Well, mixed picture. Here the FTSE 100 is not back at its all-time highs achieved before the pandemic struck, but it's certainly put in a good job of recovering quite significant ground since the lows back in the spring. But meanwhile, look overseas at the big American indices such as the Nasdaq, S&P and the Far Eastern Nikkei 225, and all of those indices have tested new peaks and seem to be continuing to do so. So how should an investor approach this type of market? And some of you might think, oh, I've seen all this before, but actually my message is not so very differently from how you'd approach any other type of market. Now the temptation is to change course at this point, and I can understand why. So some people will look at the market and think, well, I've got cash, I've been saving, I've had a job during the pandemic, if you're fortunate enough to be in that position, I haven't spent a lot of money, I've been saving, I'm going to wait. Basically, I'm nervous. But for what and for how long? In other words, effectively your market timing. So what event is it that will persuade you to go into the market on the assumption you're not in a position to stop work at the moment? And how long are you prepared to wait? And how much anxiety are you prepared to cope with if the market continues to rise? Now, no one knows for sure, but if that happens, being out of the market can get more and more stressful. And the point worth remembering is this. Basically, markets can remain irrational longer than you can remain solvent, which was Keynes. Now, effectively what that says is trying to time the market can be tricky at best. Even investing at stock market peaks actually hasn't proved to be a ridiculous strategy. I mean, no one would deliberately set out to do that necessarily, thinking, well, I need to get in at the bottom, not at the top. But actually, the chart suggests that has not been a daft strategy. And meanwhile, and this may surprise you, the mean return, the average return from the S&P 500 in the 5 years after a high since 1950 is actually slightly above the average. So for those people thinking, well, the last thing you want to do is go in and when a market peaks, you'll never recover the subsequent losses. Well, actually, it seems that you do indeed do that. Now, what's the best approach, therefore, for a nervous investor? Someone thinking, well, I've seen overseas indices approach new highs, we've had a pandemic, we've had a bull run before the pandemic, lasting the best part of 10 years. Surely, now is the time to sit on the sidelines and wait. Well, there will be some people who will do that regardless of what I say next, but I think the best approach is to take a long-term view, diversify, and consider a drip-feeding route in rather than going all in with a lump sum. Now, if you're thinking this doesn't sound terribly new, you'd be correct. It isn't terribly new. It's common sense investing. Now, let's just take these one in turn. So a long-term view, quick reminder. Now, over the long term, stock markets have risen, which is why, in one sense, there's never a bad time to go into the stock market. There are arguably better and worse times, but there's not historically been a bad time per se, provided people have taken a long-term view. This has even been true in many cases in 2020. I mean, basically the FTSE has put in a decent job since the pandemic struck, but not recovered its all-time highs by any stretch of the imagination. Other indices have done, and actually remarkably quickly in some cases. And stocks have outperformed bonds and cash over the last 50 years and have done that so far as we reach the end of 2020. And I'll put some Barclays data up just to put the long-term view out there one more time. So chart-wise, now this chart deliberately stops shy of 2020. We know that stock markets dipped sharply at the beginning of the year and then recovered equally sharply, and in some cases have gone on to push on to new highs. But here's the point. That's not a very big or long dip by some standards. It was a sharp downturn, but then the markets recovered very quickly, so sort of a V if you like. But look at this chart and you can see some much longer and in some cases heavier drawdowns, the dips you can see there, And the big one in the early 1970s, because of the way this chart is presented, doesn't look as enormous as it was, a drop of 2/3 across the market. Now, that's to do with the way the slide's been designed, but my point is this: rather than just look back over the last year, if you look at some of these enormous dips, you'll notice something about this chart, which is the market may have taken a while to get there, but it's always subsequently gone on to recover and then go higher. Now, the past is no guarantee of the future. I'm not saying this chart will just repeat itself again. No one can say that. But the fact remains, over the long term, stock markets tend to increase in value rather than the opposite. And then here's that data I mentioned. I've used this in other presentations, but the UK annual post-inflation return since 1899, according to a fairly influential study, equities around 5%, but the numbers less important than the point I want to make here. Government IOUs issued in the UK, substantially less, and cash less than that. So what we're saying is there isn't necessarily a catastrophic time to invest in stocks, provided you don't cash out straight away, having got your fingers burnt, as it were. And over the long term, there's evidence to suggest you've got a good chance of outperforming gilts, cash and inflation in equities. Now, message number 2 that I mentioned was diversify. Cover this one relatively quickly. Some of you will have heard this message before, but essentially, don't become a bandwagon trader. So don't become what I call a vaccine chaser, if that's not a horrendous expression. People jumping onto the next stock they think will be lifted up by vaccine optimism. Spread your risk. Now, CAPM suggests a minimum of 20 to 25 stocks to take away most of the single stock risk. Some people hold fewer than that. Some hold a lot more. There is no magic number. It all depends on your investment strategy, objectives, time frame, and so on. And review and rebalance. Now that is important because it's quite easy for one stock, if it's a hot technology stock, to suddenly start to dominate and skew a portfolio. So worth reviewing, not too often. I mean, you've got to look at costs in this context as well, but review certainly once a year, let's say, to make sure that your portfolio remains diversified on a relatively even basis. And then my third point was pound cost averaging. For those people thinking, well, yes, I feel like I should be in the market, I shouldn't be on the sidelines, this just offers a way of getting in volatile markets in a way that feels less risky, let's say, than committing a lump sum. Now, essentially, this drip feeds an amount into the market. It works best, arguably, if automated, because then you can just set it up and forget about it. And it minimises the cash flow hit. It's regular outgoings of cash, and also the market timing anxiety of, when should I invest next? Now, in a volatile market, this is proven to be a good way to invest. If unit prices were to go from £5 down to 2 and then back up to, say, 5 again over these periods on the left-hand side, a lump sum of £1,000 at the start would see you with 200 units at the end. Okay, but if you were to drip £1,000 in 4 goes of £250 each, essentially you buy more units for your money in the dip, and that leaves you with a higher total at the end. Now, in a rising market, in a bull market, lump sum investing will win every time. But in a volatile market, this is a way for investors who are nervous to get in without feeling that they're taking the risk, as they would see it, of a lump sum investment. So to conclusions. And basically, number 1, avoid crystal balls. No one knows what's going to happen next, but the long history of the stock market that I tried to show you before 2020, and that was deliberate, suggests that you don't need to be predicting what stocks will do next as long as you've got the right approach. And that means planning. Planning to make sure you're never a panicked seller. We don't want any of those. And you're not a forced seller either. So that's the case of getting your rainy day fund set up for emergencies, plotting those foreseeable calls on capital and making sure you're positioned to meet them, and then safely and securely committing the rest of your investable capital to equities over the long term. And don't prevaricate. In other words, don't cause yourself stress, anxiety and dragging low cash returns by waiting too long. Market timing is a bit of a mug's game, and hopefully what I've explained in this short video is that just because markets are testing new highs, that's no reason necessarily to get more and more anxious about whether or not you're going to get in on the right day of the week or the right month or even the right year. So there you have it, very big topic. Editor at killick.com with any questions, and killick.com/learn if you'd like to watch other videos around market cycles, diversification, and any of the other points that I made rather quickly in this short video presentation.